In this video, I'm going to talk about a powerful tweak to the classic breakout strategy. Stay tuned. Hey traders, a very warm welcome to you. So this is a really interesting way of tweaking the kind of classic breakout trade strategy to make it a little bit more effective and a little bit more kind of useful for the majority of the time. Now, breakouts, let's run through what a breakout is. We're probably all familiar with this, so we'll make it really brief. You know, breakout is generally when the price is about to burst through a resistance level. That could be a whole number, it could be a kind of a weekly resistance, it could be a prior day's high, any of those things. The point is it could be a trend line break, could be a chart pattern, whatever. The point is it's going to a new territory. And the general consensus is that, hey, when we break out of a level, let's say that's our resistance level, and we kind of break through, we go long on the breakthrough here and we ride it for as much as we can. Now, in the real world, very often you'll get fake outs. That's the problem with breakouts. You get caught on a fake out and then you have to come out and you get stopped out here. You get shaken out. It messes around a little bit, highs. There's very often that breakouts break down, for want of a better word. So here's a little tweak that you can use to kind of, you know, filter out some of those rougher type of trades. Now, this example here, again, just bear with me for this illustration, but we've got, you know, kind of green candles that are just pushing up and up and up. Hopefully you can see those on the screen. Green's not as good, but I want to illustrate the the strength of this move in terms of, you know, up days versus down days and what have you. So the blue represents a decent level of resistance, maybe from previous, with whatever that may be, not necessarily just something that we have as a key level. Price has moved up, we've tagged that level again, we then have a couple of days of stagnation with these red candles, and now we're going again and we're breaking out. This here is the breakout area. Now, traditionally, the textbook tells us, you know, we're going to go long on here, which if it carries on is absolutely fine. But as we saw earlier, the trouble is if it fakes out, if it messes about, you know, this is where we get caught out. So one thing you can add to it is it's very simple, is to wait for the close of the first red candle. So in other words, let this thing run, then wait and see, let the first red occur and buy it on the first red. Okay, now you can add multiple kind of different ways of doing this. You can say, I want to buy on the first red, I want to buy as we come back above the midpoint of that first red, so I buy here instead of just buying on the close here. There are many ways of doing it. In fact, let's zoom in on this candle here and let's look at how we could structure this a little bit better and the different kind of ways we could do it. So the reason we're waiting for that first red is that we want to see, you know, whether we get a genuine breakout or not. If it's a messy breakout, you might end up getting kind of the red closes under here. If it does that, we don't want to take it. The point is we want to still take it while it's above the breakout. Now, a genuine breakout is going to rip up, it's going to break through, it's going to do a little bit of consolidation, then go. And so if we're buying on that first red, yes, we're buying the momentum, but we're waiting for the momentum to unwind a little bit before we're going on. It's stopping us getting caught in any fake out intraday. So if it pushes up and then pushes down and closes out intraday and just does a complete fake out, we're not involved in that. But it keeps us on the right side, hopefully, of the market. It reduces our risk a little bit, and there's ways we can play it. So we can either do number one, which is buying on the close here. So we wait for the close of the day and we buy it on the close, and we have a stop kind of under the prior day's close or under the breakout level or something, as you would normally do with a breakout. We can then either go, another way of doing it is to say, okay, on the next day, which would be this day here, we buy on a break of the 50% range of that red day. So we kind of still waiting for that retracement. So we're not trying chasing at highs, but we're buying it on the lows. Or, you know, we can add multiple things in that, and you can play around and adjust it. Now, the disadvantage, of course, is that, you know, you could get caught out in a pullback on a fake out where it does 2 or 3 days and then comes down again, but you'd have been caught out anyway in that. You'd have been caught out buying that, and maybe you'd have taken some profits on that. But this is going to keep you in for the real beautiful trades that just stall a little bit before absolutely ripping, because many of the breakouts do that. They'll push, they'll stall a little bit, just have that first little pause, and then they'll go. Now, Could you add it to the traditional breakout? Yes, of course. You could add a little bit here, then you can add a little bit more on that first day of red, have that whole package as a trade and have a stop under where your initial stop was going to be, a little bit more additional risk, but you're trying to incrementally improve the chance of that breakout working. The point is, if you're buying on the first kind of counter trend unwinding, it's almost like, yes, we've unwound a little bit, we've not gone too far, now we're going to explode. And of course, you could have some kind of filters in for this red. That's really the point of it. You could say, hey, if this undoes and comes out below the low of the prior day, I'm not going to take it. If it's a little red and it's not much volume and it's kind of not very long, the body, then I'll take it because I'm getting a little bit of unwinding, but I'm not getting a full reversal. Again, tweak and adjust it to suit. There's just an idea to help you with the breakout strategy because, generally speaking, breakouts, if you're trying to force them, they're just going to kill you because fakeouts happen more often than breakouts do. So if we can add a little extra filter in that says, oh, only get me involved in the good breakout, so to speak. Buying on that first counter trend move in the direction of the break, as long as that's not too aggressive, as I say, not taking out multiple levels, helps you get a bit more meat in the trade. So it stops you buying late in the day. It waits, it filters out. If this day's red and it just closes down here, you're not even in it. If it's too long, you're not even in it. If it's a nice little shallow kind of stall and acceptance of price, bang, you're in it, you're looking for new highs. And if you're not, your stop is still quantified and you're kind of ready to go. And often, of course, markets will test those prior support levels. So you've got to kind of allow for that and put your stop in a reasonable position, but that at least stops you buying it on a multiple high and having much more of a wider range. All right, guys, let me know your thoughts in the comment section below, and I shall see you in the next video. Keep the risk managed. Take care. Goodbye.